Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Custody Reimagined, how Jason Wenk and Altruist are disrupting the status quo. It's a conversation with the founder and CEO of Altruist. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors. Jason, thanks for joining us today. I've been really looking forward to this conversation.
Well, thank you for having me. And I think like it's a long overdue conversation. We're having it publicly, so it's pretty awesome. Thanks for having me.
Absolutely. I've been a little bit starstruck to reach out and ask. I've always thought you've been too busy to come on our small little podcast here.
Well, not at all. I'd say quite the opposite, maybe. So here we are, both feeling a little bit awkward, but glad we got this together.
There we go. All right, let's jump in then. Can you share your background and how you got into financial services to begin with?
Sure. Yeah. I'll try to be as succinct as I can. I mean, I've been doing this for a long time, so it's the intros can sometimes get a bit verbose. But I started as an engineer, software engineer. But my first job was at Morgan Stanley. So, instead of going to work for a traditional tech company, I worked for a large investment firm and had a really great, kind of learning experience there. But was, sort of disenchanted a little bit with once you kind of get into wealth management, especially if you're a, kind of young person and you've got these, kind of idealistic views of the world. And then you realize, wow, it seems like this is very much just built for people who are already very wealthy. The transfer of value is a little bit hard for me to comprehend, meaning like the cost of financial services and wealth management, seem to be disproportionately, in favor of the vendors and providers and not necessarily the consumers. And so, very young, naive version of me decided, hey, I want to go solve all of those problems, right? So I started my first company in my early 20s, and I've been really building, software and wealth management systems, advisor networks, things like that for a little over 20 years now, and very specifically the RIA channel. So I started my first RIA in 2004, and the industry was really small, very few tech vendors. There was actually a lot of custodians back then, which was kind of funny. There's probably 10 or 12 custodians, but almost no, like the sort of like fintech solutions map concept was, probably 10 years from being born. So there was not a lot of vendors kind of serving the market, and have been really sort of impressed and surprised, but I guess in a good way, with how fast this market's grown. There's just now it's probably 10 trillion in assets, and I don't know, maybe 40,000 firms or something between all the different registration types. And it's a big, meaningful part of wealth management. But that's kind of how I got into financial services, and have kind of always towed the line between the kind of services, traditional kind of parts of it, and then building technology kind of within and for it.
It's so interesting that your realization, like very early on, and working at an incredible firm like Morgan Stanley, was that was, I guess, kind of like your worldly, or no pun intended, like altruistic view on the world. Was that like essentially you wanted to make a impact in a different way, and you can build and use your skills to enrich already folks that already had a lot of money and were already successful, or in your case. Let's kind of build the entrepreneurial dream, which is very cool. I'm curious, what's a belief that you've had about wealth management or technology that you had back in the day? Let's say when you're at Morgan Stanley, or in 2004 when you started your first company, that's meaningfully changed over time.
I think early on, because a lot of my initial work was around investment management, and I think early on I thought that was maybe the most important thing. Like people need to be better investors, and there might be better, ways to invest, and all of the work should be centered around investing. And what I've learned is that, people are so unique that there's no really such thing as a singularly best way to invest. There's a bit more of like a hierarchy of, kind of bias that is formed over our life. So even though there might be an academically superior way to invest. At the end of the day, people, they need to do something that allows them to reach their goals, kind of meets their needs, and they feel comfortable with. And if they can't do those things, they'll be kind of constantly in a state of anxiety. The anxiety will cause them to change what they're doing all of the time, and all of that change is going to create a lot of friction, in terms of the way that their money will grow and their ability to reach their goals. And this is partly why I've spent so much time working with advisors. I feel like advisors are the great equalizer here. They can coalesce sort of the facts of what is smart financial planning and smart investing with like the very real reality that humans are emotional. They can be sometimes easily persuaded. They can sometimes be a little bit too fearful when they shouldn't, and too greedy when they shouldn't. And
Mhm.
so there's a lot of value in just the behavioral coaching, and that's a really, really major part of helping people actually achieve their goals. So if you can, you still should do. People still should invest well. I mean, I think that is a very critical component to kind of getting ahead in life long term. But it's certainly not as important as I thought it was 20 years ago.
Yeah, it's not the end all be all. It's a
Yeah.
means to an end. It's how you help people achieve their goals, but there's a lot more to the relationship and the value that an advisor can bring to a client relationship. That makes a lot of sense. So the company you started, and I think you started a couple before Altruist, but the most notable one that you founded was called FormulaFolios, and you grew it from $0 in assets to over 4 billion in assets in 6 years. Can you talk a little bit about that company and what were some of the biggest lessons you had from that early venture?
Yeah, I mean, so a lot of I'd say a lot of the success there actually, was somewhat the momentum I had from the company before. So I'd started a direct consumer wealth management business in 2004. I ran it until 2011, and it's called Retirement Wealth. And it's kind of funny. You know, 21 years ago, not that many people were building retirement focused businesses. Today, I feel like I see tons of advisors who are, like retirement focused businesses. But back then it was it was a little bit unusual, but, we had a huge demographic kind of shift in America where at that time, baby boomers were kind of in their late working years. They weren't yet retired. And, I could just kind of see, hey, there's going to be this massive wave for the next 20 to 30 years of opportunity. And so I wanted to get out in front of it. And I built this kind of wealth management business specifically for people kind of, you know, I'd say age 50 and above, kind of pre-retirees and early retirees. And I did a lot of work, not just around like building, so I kind of, again, kind of leveraging my development skills, built a bunch of automation around portfolio management and kind of building, better, more automated portfolios, but also leverage technology to do a lot of digital marketing. So I like to think I was probably one of the very first bloggers and YouTubers, in the entire
Hmm.
industry. I was, putting, publishing blogs in 15 plus years ago, and had a YouTube channel in 15 plus years ago, and almost all of the demand that I had in that first firm came from the internet, especially in the later years, like, I'd say 2007, 8, 9, 10. We were growing very fast, and we had clients from all over the country, and it kind of came about, vis-a-vis, kind of the primarily the, again, blog posts and YouTube videos. So I should just to say, like, what happened was, um, as more people heard about what I was doing, again, it was the story back then was like, wow, like, you're whatever, 26 years old or something. And I went from 0 to 100 million in assets in like 2 or 3 years, maybe 3 years, I think. And that was just unusual back then. And keep in mind, like, the markets were like a fourth of the value or a fifth of the
Sure.
value there
Yeah.
today. So getting to
Really, it
100
was like
million
0 to
back then
500
is,
million.
yeah, it would have been a lot faster growth. Like, that seems like not that big a deal today, but yeah, it'd be like, yeah, probably adding 100 to 150 million a year, I guess, in today's dollars. But so so I had a fair number of advisors that started asking me, like, hey, how could I plug into what you're doing? Like, I'd love to either join your firm, or is there any way that I can, license, your software, or buy leads from you, or things like that. And that's kind of where the wheels started turning for FormulaFolios. The name is probably a terrible name in a lot of respects, but what I believed was that there was a formula for everything. The name sounds like we just were doing like some type of crazy high frequency portfolio management. The reality was, I felt like there was a formula for building a team, and there was a formula for attracting clients. There was a formula for doing financial planning. And of course, there were formulas for building portfolios. And so the platform itself was pretty end to end, meaning like the real unique value proposition we gave is we'd go out to market recruiting advisors. I felt like there was some real kind of B to B to C network effects or leverage I could get, which is a smarter way to grow than me trying to just hire and train and do all of this direct to consumer. And our message to the advisors was very simple. It was like, hey, come join us at FormulaFolios. You'll plug into our various formulas that help you grow your business. And we'll try to help you 10x within a few years. Like that was the plan. So if you come in with 50 million, we'll get you to 500, and if you come in with 10, we'll get you to 100, right? Like, we'll try to, really find like a way for you to grow. And we systematized as many things as you possibly could, built a lot of our own software. We're really, kind of thoughtful about sort of measuring the sigmas of our operational efficiency. The whole idea was like, let's remove the laws of physics as it relates to growth by creating automations and leveraging technology. And that message resonated. So we're able to attract, again, a certain number of advisors. We plugged them into sort of, again, the marketing process. They used the planning, they used the portfolios. We had, kind of, I'd say like, a meaningful amount of proprietary internal tech, but we also had really great, partner firms. So we worked with Orion and Wealthbox and, certain firms that, and this was, 12, 13 years ago. These companies weren't, Wealthbox was brand new. Orion was much smaller than they are today, but we had great partners, and these things helped us, really serve these advisors and their clients pretty well. Yeah, it was an awesome run. I learned a ton. And a lot of the things I learned in building that company were the, kind of genesis or the impetus to deciding to build a custodian.
Amazing. I mean, I'm already starting to see it, like the process flow. Like the first company you started was kind of part of what I perceive Altruist to be today. The second one built upon that, got you working with advisors directly, kind of learning what they want, what they value, and it was a bigger business. And then the pivot to Altruist. So obviously the star of the show is Altruist, your current company, which is a highly disruptive custodian at the moment. What was your initial aha moment that led you to start Altruist to begin with?
Yeah, so I think around 2015 or 2016, I started to see the early, I think that was, for what year exactly Robinhood launched, but certainly remember like watching even their wait list that they formed, and a million people signing up for this like digital, kind of app-based experience with commission-free fractional trading. And they launch, and they probably went from 0 to a million account holders in a, I don't know, 1 year or something like that, or less. I mean, it was a very, very fast journey. And I couldn't help but think to myself, man, I couldn't even imagine opening a million accounts at, Schwab, Fidelity, or TD Ameritrade, which was the three custodians we worked with at the time. It would have like, it would have completely broken our firm. That's for sure. Like, because there was so much friction in like the basics of account opening. I also started paying a lot more attention to the economics of the custody model, and growing pretty frustrated with like the way that pricing was structured. Why were they still charging commissions back then? You could look at the P&Ls of the public companies back then. Both TD and Schwab were public, and you could see that commissions were a pretty negligible part of their business. But I think most advisors, and certainly their clients, they actually believed that the cost of custody was $8 a trade. And it's like, that's not the cost of custody. Like, custody is a lot different than that. So there was a kind of like, again, like this, sort of, I'd say like handful of vectors that were, kind of coming inbound into my brain. I was synthesizing those things and going, okay, our biggest pain points at FormulaFolios was keeping up with the growth. Yeah, I'd always tell people, like, if you're like an individual advisor growing pretty slow, maybe adding a few clients a year or something like that, that means you're maybe opening 10, 15 accounts per year. It might be it might be mildly annoying, to have to use DocuSign and, wait, weeks for account processing and transfers and things like that. Um, if you if you increase that number, now let's say you're like a normal, kind of normal, fast growing firm, maybe you're adding 20 or 30 new clients a year or something like that. And at that point, you start to go, well, that's enough volume. I can hire somebody to do it for me. So I don't have to deal with it anymore. But, but it does cost me whatever the cost that employee is, so could be, who knows, $50,000, $70,000, $80,000. If you get to hyperscale, for our industry, which is like where we were at FormulaFolios, we were opening, I don't know, 50 accounts a day or something like that. And you think about, like, again, a process that maybe takes a few weeks to open those accounts, between, like, the opening, the funding, and the trading. NIGO rates, let's say, for the industry back then were 10 to 15%. So if, again, you kind of do the math on this and you're like, um, wow, it's at any given time, you might be in a follow-up state on 400 or 500, kind of clients that are trying to onboard. It becomes a really, really painful thing. And then you can kind of do that same exercise across, like, rebalancing accounts, billing accounts, doing reporting on accounts, managing RMDs, QCDs, incoming rollover checks. Like, there's obviously a lot of things that kind of happen. And if all of those things require some type of paper-based or, DocuSign-based approach, you end up having to hire a lot of people, to manage all of that. And because it's not fully automated, you introduce a lot of opportunity for error. So, kind of a long-winded answer, but those were the things that led up. Like, it wasn't like I had, like, this, like, one day I woke up and thought, wow, what a great idea. It was more a compounding of frustrations
Mhm.
that, were kind of building over the course of years. And I would push on the custodians partners we had and the tech partners we had, like, we need to solve these problems. You couldn't Six Sigma your way out of the cost. Like, there was real friction, or where this thing, again, at scale for a really good size, efficient firm, still might have 10 to 12 basis points of drag in terms of, like, you're measuring it against client assets. Like, in I felt like that was unnecessary. Like, that number should be like 1 basis point. These things should be automated. There should be very few people. The notion of a NIGO should be nearly non-existent. And nobody really, people would agree with me. Oh yeah, that'd be amazing if we could do those things. But it's like, like, no one ever did. And so that was kind of like the hair that broke the camel's back. It was around 2016 or so. Started building. I had about 30 engineers that worked for me at FormulaFolios. We started trying to build some of these things ourselves, like, on top of the existing infrastructure. So we did as deep an integration as you possibly could with TD Ameritrade. We had a full integration with Apex, and neither was sufficient. Again, part of it, I think, Apex has certainly evolved in the last 10 years, but back then they were still pretty nascent in terms of their ability to support wealth management businesses. TD's APIs were certainly helpful, but they were basically APIs to populate PDFs, right? So there was no, like, fully straight through
Right.
processing with automated, AML, KYC, CIP, and so forth. And nobody was doing fractional shares yet, and nobody was commission free yet back then, right? So it just kind of dawned on me. And I think by 2018, it was the year that I pulled the trigger. I started making the plans to step down from FormulaFolios, and then launch Altruist, which was, yeah, almost exactly 7 years ago today.
Yeah, I mean, I was going to ask you, but I think I got a pretty good answer now. Like, I mean, there's a lot of different ways you could have gone about solving your goal or your mission, from some of the pain points you saw in the industry, kind of what you believe about how investors should be served. I guess on one hand, you could have just started a a tech firm and looked to kind of retrofit what the custodians were doing to your new tech ecosystem, your your new better mousetrap. On the other hand, you could have just started a custodian and leveraged third-party technologies like most of the custodians do today. Instead, you kind of went big bang. You're like, hey, damn the torpedoes. I'm going to start a custodian and a tech company and roll it all together. And I have to imagine too. I mean, from like a funding or even just like talking to people, I mean, custody is in a super sexy segment of the market. Like, it's perceived to be relatively low margin, a lot of cost, a lot of complexity, liability, risk, etc. So maybe you can elaborate, like why build everything together rather than just going super deep on one of the core elements that Altruist does today?
Yeah, no, great observation. And many things true there. Yeah, custody is very hard, and it's very costly to build and to operate and maintain and so forth. Um, yeah, the vision was always, although many people refer to Altruist as a custodian today, the vision and the way I would describe it is, Altruist is a wealth platform. We at the core of the platform is the custodian, so we're a self clearing custodian, and that in and of itself is a non-trivial thing to build. So it's very complex, and the surface area is extremely broad. Meaning, you know to build Schwab or Fidelity or these other like existing large scale custodians, I mean, these are things that have been around for 50 plus
Yeah.
years. So to think you can just build all of that surface area, all of the account types and all of the security to support different security types, like, nail all of the workflows, the user management, harden the systems for uptime and stability. um, it is a big build, right? So, but to me, if you just rebuilding something that's not great, and just building a new version of not great, kind of seems like a poor use of time and talent and capital. So when I look back, I mean, in first principles, I would say that going back to my very first RIA, I remember back then I worked with TD Waterhouse. They were the only custodian that would take me because I was, didn't have any clients, I didn't have any assets. And I remember kind of going through their onboarding and, kind of being like, okay, this is how we log in. Okay, how do we open accounts? Okay, well, they showed me the resource center where I could download the forms, which I did ask the question back then. I was like, well, but wait a minute, I can just go to TD Ameritrade right now and open an account online, as as an individual. Why can't I do that for my clients? And they gave me 10,000 excuses as to why they couldn't do it, but basically you couldn't do it. And I thought that's strange because literally 25 years ago, a consumer didn't have to use DocuSign. They could just go in and open an account and have an account. But advisors couldn't. So I thought that's strange. Again, that was 20 years ago. Then I remember going, okay, well, when I want to invest the money, let's go through like the investing workflows. And they were all individual accounts, like one account at a time. I'm like, well, that's not going to work. Like, what if you have 100 clients? You're just going to do 100 trade. You're going to add 100 client accounts to your trade blotter and push your trade blotter through. And they're like, well, you could use a third party software. They introduced me then to their affinity center, they called it back then, where they had, maybe there was a dozen or 10 to 20, tech vendors. They could, so if you wanted an institutional rebalancer, you could go pay for that third party. And I thought, well, that's kind of odd. Why wouldn't you just have that built right into your custodial platform? Okay, let's talk about, it's time to bill on a client account. Like, how do I do that? Oh, okay. Well, you're just going to upload this spreadsheet with your calculations. I'm like, well, how am I going to do the calculations? Well, you could do it two, our customers do it two ways. One is they just put it into a spreadsheet. They build a spreadsheet, put a calculator, or some use a third party billing software. You can find those in the Affinity Center. I'm like,
Yeah.
that seems crazy. Like, you guys already have the data. Why wouldn't you just like build a simple little, UI where I could plug in what the fee is and then you just calculate it and debit the account and send me the money? Well, we don't do that, right? And here's all the reasons why. Okay, final step. I've got a client. I've got to get ready for a review meeting, and I need to figure out how to run a report, to tell them how they're doing. Where do I do that in the platform? Oh, you can't do that on our platform. You can only look at accounts one account at a time, and we don't have consolidated performance reporting. But you can go to the Affinity Center and you can find a vendor for that, right? And
Yeah.
I just thought to myself, I'm like, this is the craziest thing ever that this is how things are done. And everybody was doing it that same way. Like, it wasn't unique to TD Waterhouse back then. It was like everybody did that way.
Yeah.
And it just felt really odd to me because, again, if you're thinking, if you're not, if you remove the knowledge of how the industry works and you're just saying, well, how should it be? Well, how it should be is you should be able to open accounts online with no paper. You should be able to self-serve and make changes just like you could if you were a consumer. It should be fast. It should be 95+% automated, so no humans needed on the back end. There should be very little reason to ever even check. You'd have to call in for a status check or, like do a follow up, on a follow up because you're wondering what the status of an account opening or transfer is. And everything I just mentioned, those all should be built right into your custodian. Like they should never have been segregated services or tools. Um, and the custodian has a huge advantage because they already have the data. They have it in real time, whereas all these third party applications don't even have real time data. You're sending them yesterday's data via an overnight file. It's an incredibly fragmented file, meaning it's nothing's reconciled. It's positions and transactions. And then you have to take those and match it to your existing database to do things like performance calculations. And this is why for 20 years, advisors sometimes scratch their head and go, why is my performance in my portfolio accounting system slightly different than in my
Right.
custodial platform, right? It's because like, these third party systems are trying to reconcile a bunch of, kind of individual transactions. And they might be doing it just slightly different than the custodian. And it creates some type of like, delta in how they calculate IRR or even account value, which is kind of bonkers. So with Altruist, I just like, look, if we're going to do this, like, let's do it right. Like, let's not do it like everyone else has done it. Let's build a vertically integrated solution where, we do most of the key things like performance reporting and fee billing, model-based trading, kind of with like a UMA architecture so you can blend models. Let's do it all with fractional shares. Let's make it commission free. And if someone wants to use a third-party software, we'll make the whole entire stack a collection of APIs. So it's very easy to integrate with other tech tools. But you don't have to if you don't want to, right? It's like it's total optionality for the advisor. And again, I would take, I would, yeah, I would debate heavily anyone who argues that's not the right way to do it if you're thinking in sort of a principled manner. So we just built it the way custody should be, right? And there's massive efficiency gains too when you do that. Like again, the system works better, the system works in real time, everything's lower cost. Because we're vertically integrating the platform, so everything from again software, asset management, and so forth. Each layer of the sort of platform is far cheaper than if it was bought individually, right? So
Mm.
you end up having a lower cost to the advisor, better economics to the client. It's just again the way things probably should have been done 20 plus years ago.
Yeah, so
But
basically it was like
yeah,
there's a better way, and I can just kind of
totally, yeah.
go along with what's out there, which probably 99.999% of people would do and do, or I can just kind of take like meet this challenge head on. But I mean, I have to imagine. I mean, the idea of your competitors being Schwab with 5.5 trillion in assets, Fidelity with over 16 trillion of assets under administration, BNY Mellon Pershing, the largest clearing firm in the world. Like that's a pretty lofty set of competitors to go after. How'd you get comfortable taking them on?
Well, I guess I don't always view it as yeah, I guess I've never really viewed it as competition as much as because if we look at those three companies, for example, I mean, you'd know this probably better than almost anybody. There's very little lateral movement between them. Like you don't see a whole lot of people who are like, $1 billion Fidelity customer that
Right.
just decides to go and move to Schwab. So when I look at the industry, keep in mind that when I started, I think the total assets in the entire, kind of RIA ecosystem was probably under a trillion. It was probably like 600 billion or so in
Wow.
2004. And there was back then only a few thousand firms. Again, obviously, you probably know better than anybody how many firms are being formed every year. Like, what's the opportunity, kind of to move from, broker dealer to the RA channel, wirehouse, regional bank, et cetera, et cetera. Right. So there's a lot of people. It's kind of a best I can tell, it's a one-way street, where you don't see people leaving the RIA ecosystem to go back to a wirehouse, but you do see everybody else kind of coming into this channel from the others. So I think that the best way to kind of think about it is that there are certain things Schwab and Fidelity and Pershing do that they're probably really good at, and those assets are probably always going to stay there, and that's totally okay. And we've never cared about that much. What I think about is similar to that thesis I had in forming retirement wealth back in 2004. Back then, again, not as many people were serving retirees because it wasn't as big of a market as it is today. Today, all those baby boomers are all retired, and there's a lot more assets there than there ever has been in that retirement kind of channel. When I think about Altruist, who are we building for? Well, we're building for Sometimes we use the term modern firms. Sometimes we call them forward-thinking firms. But basically, it's the firms that we're making a bet are going to be the biggest firms in the industry in 10 or 15 or 20 years. Just like I made that bet in
Yeah.
2004 on baby boomers. And all of the demographics suggest that that's exactly what will happen. You're going to see, you know, tens of thousands of firm principals retire over the next 10, 15, 20 years. There's a lot of consolidation with aggregators, but the great irony is someone has to take care of those clients, and not that many advisors want to be a W-2 employee of some private equity backed $300 billion RIA.
Yeah.
A lot of young people are strongly opinionated about like what they think good advice should look like. They want to serve clients that that they choose, and maybe even people from their own generation. They want to have demographic alignment. They might have strong views on what great technology and experiences look like. And those advisors are huge raving fans of Altruist. Like we think there's no, I don't have like precise data on this, but I'd say like the net promoter score right now on like a core Altruist advisor is in the 70s. Like that's unheard of in our
Yeah.
industry. We have like raving fans as customers, and most of the customers, I mean, although they range in ages, we certainly have people who are in their 60s, even 70s as advisors. But we also have the largest base of young advisors. Like it's not even remotely close. Like if you're an advisor that's in your 40s or 30s or 20s, why would you want to build a business on top of
Yep.
50-year-old rails? Like you want to build a
Makes
modern
sense.
business that's built to, really built for the
But
next
with
50
the, I just want to
years.
make sure I tug on that point. So I think it's very smart. It's like basically I see a blue ocean opportunity. Like my bet is if I can capture the younger, presumably more tech savvy emerging advisors, those are the next billion, 2 billion, $10 billion firms of the future. And that's not really a segment that the traditional custodians are targeting. But as far as today, doesn't that mean that the core client is going to be relatively small? Like you're not, that means you're not getting the more mature firms that tend to have more in assets. Is that a fair way to look at it? And how do you square that?
Yeah, I mean, I say not always, right? So if you think about some of the firms we've done press releases on recently, like Ritholtz Wealth
Yeah.
Management, the core of their team are in their 30s and 40s. If you look at even Bryn Mawr Trust, who we just added as a client, led by Jamie Hopkins, who I believe is maybe early 40s.
Yeah.
It's been pretty well documented that we were the first custodian for James Knoll at Root Financial, which is one of the fastest growing firms
Yeah.
in the country, basically 0 to 2 billion in assets in like 3 or 4 years, and growing at the highest rate I've ever seen any firm grow at organically.
That's
I mean, it's
crazy.
quite remarkable. James is in his early 30s, right? So we start looking through. We just added another firm. I think the press release will come out shortly on this one. Again, advisor that started it. The firm is 950 million. Principal advisor is 42 years old.
Wow.
They're growing really fast, right? So what you're finding is that there's already firms that are in the billions, multi-billions, even tens of billions, and they're being run by people in their 40s and 30s. Like these are not people that are 80 years old, right? That are
Fair.
running these
Yep.
businesses. And the really wild part is all of those businesses I just mentioned 10 years ago weren't at $1 billion, right? Some of them didn't exist 10 years ago. Some of
Yep.
the people were still in college 10 years ago, right?
Yeah.
So I think there's a misconception that you can't be successful. Keep in mind that my last company hit $1 billion in assets when I was 33 years old. It's by the time I was 35, I had two RAs that I owned that were both over $1 billion in assets. Uh, if I was still running the old company today, it's a $13 billion RA. And again, I'm still in my mid 40s, right? So I think there's this like huge misconception that like you can't be very successful. And I think every advisor out there in their 40s that's like managing 500 million or a billion or 5 billion or 10 billion
Yep.
is probably going, yeah, of course, like we can build big firms. Like age isn't a much of a
Yeah.
barrier,
I agree.
really. So we certainly have some of that, but I do think that the even the it doesn't, age is probably the wrong thing to anchor on, because again, there's people we meet with that are in their 50s and 60s, and they're still thinking about the business for the next 20
Yeah.
years.
Fair.
And this is one of those businesses where you can, like, you don't ever really have to retire. You can keep doing this, as long as your mind is sharp and your body is able, like you can keep, providing advice and building a firm. So I think that, again, anyone who's like looking at the next 20 years, there's a uh, strong chance that they're either on Altruist or they'll add it in the next year. And the flows that will come into those businesses over the next 10 or 20 years, I think high probability they'll end up here at Altruist, meaning
Hmm.
like, if we get some of the back book, we call it, like the assets at the other places, wonderful. And then the last thing I would just say is, like, this is probably highly relevant, to your world, but about a third of all of our flows come from breakaway advisors.
Hmm.
And so if you're launching a new firm from scratch, why on earth would you go to a 50-year-old platform and then have to cobble on
Yeah,
six or
fair.
seven different pieces of software, create all of this complexity, have to train your staff on all these disconnected kind of, fragmented tools, when they can come over, join Altruist? It's insanely simple and highly integrated, and their economics are way better, right? So our fastest area of growth, which is probably consistent with most of the other custodians, is just the people coming into the space brand new. And of course, it's competitive, but it is pretty wild. When we look at, like, we see obviously how many firms are registered each year, and the number that choose altruist is quite high. So there's a reason why we were able to get, to some level of scale fairly quickly. It wasn't necessarily that we were poaching people from Schwab and Fidelity. It was actually that we're just winning a lot of, like, the new money
New
coming
stuff makes
into the
sense.
system.
I mean, it almost sounds like the dynamic of, like, when you hear the self-clearing broker dealers and firms talking about their technology, they talk about it in somewhat of a similar way versus an RIA or a broker dealer that clears through Fidelity National Financial or Pershing, where it's like it's our systems, our platform, we build it for our custodian, our service team, etc. It's almost like the RIA version of that. It's just an observation. But I want to ask you about brand. You mentioned in the breakaway segment being a major area of growth for you. I mean, what I normally see is advisors coming from Wells Fargo, UBS, Merrill, Morgan Stanley, JP Morgan, et cetera. Like, they're accustomed to being surrounded by a big brand, some of the biggest brands in the world. That means a lot of times people, if they move, they're going to move within their channel, which is totally fine. The ones that decide to come into the RA world, a lot of times they still have the brand stigma kind of in their mind. And to them, Goldman Sachs now, Schwab, Fidelity, BNY Mellon, Pershing, Raymond James, like, those are brands at least that their clients will know and have heard of. How do you overcome the brand dynamic? Like, not to say Altruist wouldn't be a household brand in 5 or 10 years, but today I'd say it's well known amongst advisors, but not with clients. So how do you
Yeah.
coach? How do you coach folks, or how do you overcome that objection? To me, I think a lot of times the custody decision, rightly or wrongly, is predicated on which brand are my clients going to feel the most comfortable with.
Yeah, that's a great observation. It's funny. We had an event here in Southern California 2 weeks ago, and one of the new larger firms that came onto Altruist spoke, and spoke to the other 50 or so advisors there. And that question came up. Someone asked the advisor, as they were kind of on stage, "Hey, how did you overcome, like, the fact that your clients had never heard of Altruist before?" And whereas they probably heard of Schwab or Fidelity, et cetera. In his response, it was so matter of fact. He goes, "Well, I just tell them I can work with any custodian I want." And I chose Altruist, and here's why I chose
Hmm.
Altruist. And he went through some of his reasons for choosing it. And he's like, no client pushes back at all. Like, it's not like I couldn't work with these other firms. Of course I could, but my job is to choose the best possible place for my clients. Now, we have to do a little bit of educating because I think a lot of people don't understand that, if you're a DTCC member firm, which we all are, every firm you mentioned, like, in other words, if you can do an ACAT, if you're an ACAT
Hmm.
eligible firm, all of the money's in the same place. Like, all of the securities are actually held by
Fair.
DTCC. They're not held by Fidelity or Schwab or Altruist, right? They're held by DTCC. And when you do an ACAT, what's happening is there's literally a box number at DTCC that they change. Hey, these securities that we're holding for Schwab, now we're going to change it to the box number, right, for Altruist, right? And that's literally it. But the securities stay in the exact same place, which is kind of interesting. So we have to educate people a little bit. Like, a lot of advisors don't understand that. Obviously, everybody has the same SIPC insurance. Everybody has, for the most part, we all have the exact same reinsurance. Like it'll be like a giant policy through Lloyd's of London. So there's no delta in safety.
Hmm.
And if a client was to ask that question, usually that's what they're trying to get to is, hey,
Yep.
how are you sure my money's going
Exactly.
to be safe there? And it's like, if you can just say, hey, the money, the safety is the same at all of these firms. There's no delta in safety. So I make my choice, given that, like that the most important thing is that the money's safe. Then it comes down to where can I drive the best possible outcomes for my clients? If you go through that list that you just rattled off there, where are you going to get the best results for your clients? Well, it's going to be Altruist. It's not going to be those other firms. Why is that? Well, at Altruist, you're going to have access to things like fractional shares. With fractional shares, you're going to have more of your money invested. More money invested is less cash drag. Less
Mhm.
cash drag, higher returns in your accounts. By having fractional shares, I also can eliminate the need for a lot of packaged products. So I don't have to use as many mutual funds and ETFs. Even though some of those are okay, there's still an expense ratio. That little bit of expense ratio, that's friction. That little bit of
Sure. Yeah.
friction reduces the after tax returns, after fee returns to my client accounts. By having fractional shares, I can also get individual securities. This gives me more positions and more tax lots. So if I want to do things like tax loss harvesting, I can drive better after tax returns for my clients. You just keep going down the list, right? Altruist has a high yield cash account. If my clients have a need for idle cash, you can earn the highest rate in the entire industry directly at
Mhm.
Altruist, a far higher rate than you can get any other custodian. So your idle cash, when you do want to have it for some type of emergency or planning, you're going to get a better yield here than you will at the other places. And you just keep going down this. Like at some point, the clients are like, whoa, 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 okay, I've heard enough. Like it sounds like I clearly get better results here. And I really appreciate that what you're thinking about is that one, is my money safe? Two, how do I get the best possible results? Exact same investment strategy, just applied across two
Yep.
different custodians will drive different outcomes. So we've really tried to be thoughtful there. I mean, obviously, some advisors may or may not choose to also say, like, hey, look, we also want to deliver to our clients an incredible user experience. Money is one of these things where very few clients will actually know the difference between 0.4% and better returns or something because of less cash drag or tax
Right.
efficiency. But they do want to know, what do I have? Like, how am I doing? Is everything going to be okay? Like
Hmm.
that type of experience is incredibly important to clients. And where else can you deliver that experience other than Altruist? And the answer is nowhere. Like you'd have to buy a bunch of other software and tell your clients, well, if you want to know what you have. I guess you could get that, from the custodial login. But if you want to really know what you have, like, if you're like kind of just curious, like, am I properly diversified or, like what's my blend between, stocks and bonds and alts or whatever, then I'm going to have to go log into this third party software because my custodian can't tell you that. Right. So you log in this other software. How am I doing? Well, again, can't get that through the custodian either. So, you have to go to our performance reporting system. Whoa, there's a crazy thing that just happened in the market today. I want to log in and see how I'm doing. Well, you can't get that from that third party platform because that's yesterday's data. So sorry, but yeah, if there's a huge flash crash, like you're just going to have to wait till tomorrow, to see how you're doing. It's like, so again, fundamentally, even things like user experience, a lot of the user experience isn't just pretty design. Of course, we have stunning, beautiful design, but the user experience is an experience. It is the fact that most people, what really matters to them about money is, what do I have? How am I doing? Is everything going to be okay? And it's very hard to do that at other platforms because the data is all in different places and you have to tell your clients to log in. And it just ends up becoming more than a client wants to do. Their level of frustration will pick up. And will they express that to advisors? I mean, maybe. Most of them won't. They'll just kind of complain about it. There was actually a really interesting podcast. I don't know if you ever listened to 20 VC with Harry Stebbings, but he had one where they were all talking about just how terrible wealth management is. And these are like it's a bunch of people that are very wealthy, and some of them are probably billionaires that were on this podcast. And they were just like ripping apart all of the big firms that like people think of as like, oh, these are the default safe options to bring my clients to. And like the reality is when clients start talking candidly about their experiences, they're like, this stuff is terrible. The experience is terrible. The fees are too high. Like that's how they really feel. But they're not going to express that to advisors. So why not just get out in front of it and deliver that absolutely world-class experience that gives people what they really want. Some level of comfort and security in knowing like they can easily get access to what they have, how they're doing, and everything's going to be okay, and they can do it in real time. So these are like, again, I think in the end, I view like the folks who just opt into the easy, safe solution is like, kind of a lazy approach. Like,
Hmm.
they forget that when you go RIA, you're taking a fiduciary oath. You're actually attesting to the SEC that you're doing diligence on your custodians, and you're trying to choose one that is going to drive the best possible outcomes for your clients and keep their money safe. And yet most people will say, well, I'm already in the Ray J channel. I'm just going to go RIA and stay in the Ray J channel because it's easiest for me and it's low
Hmm.
friction. I don't even know if it's what's best for my clients. I have no idea. I don't know if my clients even like it, but it's just low friction. So
Yeah.
therefore, I'm going to go that route, right? And I think that same thing applies to a lot of other decisions, kind of in the marketplace. And hopefully, over time, advisors kind of wise up to like, hey, it's always a good idea to do what's best for your clients. Like always a good idea. And I think the notion of like, um, yeah, kind of justifying a, a behavior that, if we're being honest, is a little bit selfish. Meaning like this is the easy path of least resistance. Um, I'm not going to get fired for taking this path. I don't have to do a lot of explaining if I take this path. So, I'm just going to take this path, and here's all the reasons why it's a great idea, right? And that justification, I think, is um, part of why we have a bad reputation in this industry. Versus maybe the self perception. So it's to me, it's just I'm betting obviously that um, that the Altruist flywheel will end up looking a lot like Vanguard's flywheel. So if you've ever read Good to Great, they share the Vanguard flywheel, which is number one, we're going to have the lowest cost industry. The lowest cost is going to drive the highest returns. The highest returns is going to drive the highest the best possible investor outcomes and satisfaction. That's going to make them put more of their money with Vanguard. That's going to give us more scale, which allows us to lower our prices even further, to drive the performance even higher, to make the people even happier. In other words, like it's so centered around investor outcomes. And then you go, maybe that recipe is not so bad. They've got something like 10 trillion in assets. Maybe it's working, and I think advisors can take a lot of lessons from that.
Yeah, no, it makes sense. Like it's one of those things. Like I see it all the time especially with breakaways where they're afraid or worried about how to explain the RA model or how to even explain like why I went to RBC or Stifel or Ray J versus going from UBS to Morgan Stanley. And obviously, people do it all the time. This is kind of the next level or the next layer of it, which is you really got to understand it. And if you really focus on the benefits and how it's tangibly better, you got to kind of just trust that the brand, really the components of brand that people care about, I agree with you, is asset safety, its tools and resources, et cetera. And if you can land the plane from a sales standpoint that your team does, and then from the client to the, from the RIA client to their investor client, that's the whole ballgame. But it takes two willing participants. It takes the advisor or firm
100%.
owner that's willing to kind of take that bet, and then it takes the client that's willing to take that bet as well. And I think there's a pretty meaningful fear gap right now, which is look, it is what it is. At the end of the day, it's
Yeah.
people's businesses, and you got to respect it. But
Oh yeah.
thank you. That honestly helps me understand the brand
And I
perception a little bit
suspect you've
better. How does
you've probably seen this with other moves, by the way, is that I would imagine 99% of clients don't ask. Like they're kind of like, meaning they don't. I shouldn't say they don't ask, but they don't ask like, well, why'd you choose this firm over that? It's just sort of like they trust the advisors so much, like that the advisors who they hired. It's really just the 1%. Sometimes people make a huge decision because they're afraid that 1% of the clients will
I
ask them.
completely agree.
You
Yeah, it's
know,
like the
yeah,
loss aversion bias. You value your losses
100%. Yeah.
more than the gains. Um, simple question: how does Altruist make money? I mean, you're talking about like a much higher yielding checking account than other custodians. Like all this technology has to be pretty expensive. Talking about having a low cost model for advisors and clients. Like how do you make money?
Yeah. So easy question. I'll give you the shortest answer I can, but we make money in each layer of the stack, right? So you think about when we use the term vertical integration, there's the core custody layer, and at the custody layer, we make money similar to other custodians. So net interest income, like there is still a spread on cash, although we
Yep.
pay a higher yield on like our high yield cash product. There is still a spread there. Um, because we're all digital, we have a very high opt-in rate to something called fully paid securities lending. Basically, if I own Tesla and you want to short Tesla, you have to borrow it from somebody and you have to pay for that right, vis-a-vis a margin loan from your broker. The client actually costs them nothing. They actually get 30% of the revenue. So anytime
Hmm.
we lend a security, we get paid. We give 30% of the yield to the client. So they get free yield on their securities.
Wow.
And then we obviously make the difference for brokering kind of the transaction. So that's pretty meaningful for us. I think we have the highest opt-in rate in the industry because most places, most people, I think, would benefit a lot from adding securities lending to their portfolio. It's fully collateralized and safe and easy to do. It's fully automated. And again, it only actually increases the yield in a client account, no cost to them.
Yep.
But to do that at most custodians, you have to download a form from a resource center, fill out a bunch of paperwork, send it to the client, have them sign it. And so because it adds that little bit of friction in client onboarding, which is already a pretty bad
Yep.
experience at most other custodians, advisors just don't bother doing it. So the opt-in rates to things like fully paid lending is,
Yep.
2 to 5% at a lot of other places. At Altruist, it's more like 60 to 70%. So we have certain revenue centers actually here that are far greater than other custodians. But it's interesting; it doesn't cost the client anything. Actually, it is part of what drives better outcomes to the client. Like we have far more participants in these programs getting additional yield on their holdings. Um, we have a model marketplace. So again, there's a percentage of advisors that don't want to manage their own portfolios. They can use our model marketplace. Um, Again, interestingly, if someone's running a standalone, asset management, kind of like a TAMP or yeah, like a marketplace of sorts. If it's the only business you have to charge a pretty high price. For us, it's just again a part of the stack. So we keep the costs much lower, typically 50 to 80% cheaper than where you could get
Wow.
these same portfolios elsewhere. But for us, that's incremental revenue. You add that to that custody layer, and now we earn revenue there. We also provide our software on any custodial account. So again, on the Altruist accounts, all of our software is free. But if you want to have us take care of your performance reporting and fee billing on, some
Wow. Makes
Schwab
sense.
accounts, if you're
Yep.
multi-custodial, we charge $1 per account per month on those third-party accounts. Again, if you compare that to most portfolio accounting or portfolio management systems, most are charging a lot higher than $12 per
Yep.
account. We're able to, because it's just one part of the stack, we bring the price down 50 to 70% compared to what you'd be buying that standalone. We have our Hazel AI product, which has been an awesome kind of new addition to the Altruist lineup. And again, if you're buying a standalone AI assistant, that's going to be most of the leading products are like $100 to $140 per month per user. Hazel is 60,
Wow.
right? So much lower cost. It's actually incredibly powerful. It also has access to data that no other AI system can have because it's fully integrated into the custodial data of Altruist. Um, but again, how do we make money? Well, we now have SaaS fees like for things like AI tools. Again, much lower
I mean,
cost than if you're buying these things
it's
separately, but you
brilliant. It's
start
like
stacking these
it's
things
not
up.
like
Yeah,
you're running a nonprofit. Like clearly, you're focused
100%.
on driving revenue, driving returns uh, for your shareholders, and being able to reinvest in the firm. It's just the ways in which and the magnitude in which you make margin are different compared to other players in the marketplace.
Yeah, this is why I refer to Altruist, often as again a wealth platform. It's a very AI first wealth platform. It happens to have custody at its core, but all of these other things. The end result, quite interestingly, is like our total revenue per dollar on platform is considerably higher than most of our competitors
Wow.
because we have 5 or 6 lines of revenue. And then we operate at a much lower cost because all of the things we build have very high degrees of automation. So roughly 95% automation.
Wow.
And there's even simple things like some people would say, like, oh, I want to be able to call and talk to, Susie on the support team within 2 rings every time I call. Well, that's very expensive if you want Susie to answer within 2 rings every single time you call, because that could be thousands of support staff sitting behind
Yeah.
there just waiting for you to call all day. Like, whereas if you look at the data, cost to support advisors, almost 50% of all inbound calls to custodians and broker dealers are for status updates. Hey,
Hmm.
what's the status of that check that we mailed? I don't see it in the client account,
Yep.
right? Some human being then has to track it down and give you a status update. Well, why not just put the status, the exact status that we would have, and put it on the advisor portal? So, like, there's no
Yeah.
advantage to calling us. Like, you see exactly the same things we do in real time. What if we, on top of that, add AI into our platform? And if you don't even want to go look up, where the status request is, you could just ask the AI, hey, what's the status of Lewis's, check that he sent in?
Yep.
And the AI can just give you the same answer. And when we measure the satisfaction, like the satisfaction rate from things like AI assisted customer support is incredibly high. I mean, it's like, I think on a scale of 1 to 5, it's 4.5 or something. It's
Wow.
actually higher than human based support at most organizations. So these are all interesting things about the economic model of Altruist. Like, we do make revenue. We're definitely not a nonprofit, but we're also way more efficient. So if you drive more revenue and you're able to do it with lower costs, obviously you have better margins both on the gross and on the EBIT side. This allows us to invest more into R&D than anyone else can. So again, on a relative basis, how many engineers do we have relative to assets on platform? There's a reason why we're moving way faster than everyone else in the space. Like,
Makes
we're
sense.
able to just kind of make these bets that other people can't, because we don't have that same like super constrained margin profile that is kind of like, this, I kind of call it like one of those like, commonly held beliefs. I think it was done so that it would scare people out of trying to build custodians, like, oh, it's a scale business, requires trillions in assets, the margins are razor thin.
Mhm.
Again, there's some truth to some of that, but if you build it the right way, just like, I'm sure people probably told Elon Musk he was crazy for building Tesla. Oh, the car industry is way too hard. It's
Mhm.
capital intensive. The margins are razor thin. And then he's out there selling cars for $30,000, profitably with
True.
reoccurring revenue because of all the subscription elements and the charging network, right? So just completely flip the economics of like the automotive industry on its head. Um, we'd be wise to be careful, the commonly held beliefs that we accept as our own and the source that they came from.
Yep. Well said. I mean, another fascinating answer. Let me ask you two more quick questions, and then we'll let you get on with changing the industry. So, I think from the beginning, you raised institutional capital, like a venture money, et cetera. How do you think about the funding of Altruist, and what's the what's the future as far as the funding strategy? Is it to IPO? Is it to stay private? Is it to scale it and sell it to one of the major custodians? Like what? And I know you don't have a crystal ball and et cetera, but how do you perceive the future from a financial standpoint for Altruist?
Yeah, so I think it'd be impossible to bootstrap something like this unless you were already, a multi-billionaire and, doing it, kind of, you
Yep.
know, yeah, from your own personal kind of cash vault or something like that. So we've raised a little over $600 million
Wow.
to date, and the very first round of funding was, I want to say, maybe just like the kind of seed capital, if you will, was maybe around $8 or $9 million. We did a quick follow-on round after that, and added another maybe 10 million to it. That allowed us to get basically a very, very crude, MVP. We didn't own our own clearing. The product had very few features, but we could kind of,
Yep.
stand something up for advisors to use that had very simple businesses, and engage the advisor reaction. And then, all the subsequent rounds are based on milestones, right? So that first round and the first customers, like, we were able to show, hey, there's some real serious demand here. In fact, we had, I don't know, 1,000x the demand that we could support. Like, we had just hundreds of
Wow.
billions of dollars of RIAs coming to us being like, this looks really fascinating. We'd love to be able to use this product. And then we'd have to go back to them and say, that's an awesome signal. We can't support you yet because we only have like 7 features, but, this will help us kind of build out more. And when we're ready, we'll come back to you, right? And so then, each phase along the way, so I'd say pretty much every year, so like once a year, we've been very fortunate that investors have actually been very excited about this industry. Again, the RIA industry has been a very big, kind of, natural organic grower for the last 20 years. That trend is not expected to slow down. you had tons of consolidation at the top. So when there used to be 10 or 12 custodians, today there's really, in the RA channel, there's really just two, right?
Yeah.
I mean, Pershing's largely not relevant in the RA channel. They do a ton with broker dealers in supporting the RIA, corporate RIAs of BDs, but very few RIAs are going directly to
Mhm.
Pershing. It is probably 80+% Schwab and Fidelity when you look at the 10 trillion, in the RIA, the singular RIA market. Investors like that. That looks like an oligopoly to them, right? Or a
Yep.
duopoly to them. And they kind of go, okay, if this market continues to expand in the 10 to 15% CAGR range for the next, let's say 2 decades, you're going to go from 10 trillion in assets to, I don't know, $40 trillion or something, $35 trillion in assets. How big does Altruist have to be to become a very big, meaningful public company, right? Well, maybe $1 trillion or 2 of assets, and it's a
Right.
very large
Like in other words,
multi-deca-billion dollar
you
public
don't
company.
have to chase down Schwab or Fidelity to have an
No.
incredible business with incredible outcomes for your investors.
100%. Yeah. Obviously, we hope to become the dominant, and we're building to become the best platform. But the inertia will keep those other firms very big for many decades, and it will take, again, like this sort of full cycle of demographic change before there's likely to be a new leader of the pack, if you will. So yeah, we've never had a challenge, because I think investors, what they want is they want it back. Really talented teams pursuing really massive markets where winning results in large deca-billion dollar outcomes, if not $100 billion dollar outcomes. Um, and we certainly have the opportunity to do that. Doesn't mean it's guaranteed. We're gonna have to absolutely bust our ass, and we're gonna have to sustain this for a long time, and maybe get a little bit lucky too along the way. And if all those things play out, then we have that kind of asymmetric upside to the business. And so for all those reasons, I mean, the most likely outcome, even from day one, I always kind of assumed here, we stay private for maybe 10 to 12 years, and then we look at, is it appropriate to go public?
Hmm.
I don't think being acquired is very likely. There's a lot of reasons why, but that was one. That's never been my personal pursuit. But even outside of my own personal views, it's hard to imagine. When you like, first of all, who could even buy us? Like, there's only a few companies that are big enough to buy us. It's not like we're a small business. And then those firms that are big enough to do it, would they be allowed to for regulatory reasons? Like, there's not a lot of competition already in this space, and if you take Altruist out of the mix, there's a lot less,
Yep.
because we're probably the only firm that's really meaningfully grabbing market share here. And so I think, taking us out and then having it just be Schwab and Fidelity and, a half dozen kind of, like subscale players is probably not great for the industry. So, but we'll see. So I think that's kind of like the view. Again, I think it takes a lot of money to do it. You have to have great investors that have a long-term time horizon. They understand and appreciate the space. And we certainly don't have to go public, but I do think it's one of those things where if you want to become that household name, which
Yep.
reduces that amount of friction for advisors and their clients, it's really nice if we're able to eventually tell people, hey, just go pull up our ticker and
Yep.
check out our financials, and the consumer, I think, would feel more comfortable. And so I do think that's probably one of the better paths for us.
Fantastic. I lied like that. Well, let's wrap there because that was a great answer. But this has been
Thank you.
honestly eye opening. Like, I mean, just gave me like I definitely was guilty of having preconceived notions about what Altruist was, who it served, how to think about it. So even just from a professional standpoint, I think you shed light in a very compelling and and smart way about the core elements of Altruist, why you decided to build a all-in-one custodian and tech stack, and just the various ways that you're helping advance the pursuit and the altruism of the industry. That time pun was intended.
Thank you. Thank you.
Really appreciate it.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.